What if I told you that right now, millions of investors on Trading 212 are pouring their hard-earned money into just 5 stocks? Millions of people, 5 stocks. And that always makes me ask myself, does this group of people know something I don't? Am I missing out if I don't invest in these? Or are there too many people on the boat and the boat is about to sink? In today's video, we're going to break down these 5 giants one by one. I pulled the raw financial data combined with their latest developments to show you exactly where these companies are now, what their futures could look like, and whether we should be investing in them too. And at the end, I'm going to put all 5 side by side to see which stocks have the best potential growth for your portfolio right now. So, let's get started. Now, before we jump into the stocks, just a reminder that I'm not a financial advisor and this is not financial advice or a recommendation. I'm just sharing my own investing journey, and it's important to do your own research and take your own risk appetite into account because investment values can go up as well as down. Now, if you're using Trading 212, you might have noticed a section at the top of the platform that shows the most owned stocks from all of its users. And right now, the top 5 stocks in this section are none other than Nvidia, Microsoft, Apple, Amazon, and Tesla. So if you're looking to build a portfolio, these are the most popular options, and they are some of the biggest companies in the world. In fact, you might already have them in your portfolio, and I've had them too. But when I looked into the data for this video, the picture has shifted dramatically in just the last few months. One of these stocks has become a jaw-dropping gamble. One is looking like the best value play it's been in years, and a couple of them are genuinely compelling opportunities. So let's jump in and start with Tesla. Now, to understand where Tesla is heading, we have to look past what made them famous, because their primary focus right now is moving from pure electric vehicles into an AI, robotics, and energy infrastructure company. Tesla is having an eventful year. The Model Y Juniper refresh is rolling out, the Tesla Semi is pushing towards volume production, and importantly, Cybercab production is set to begin this April in Texas. This is their dedicated robo-taxi with no steering wheel or pedals and shows their biggest bet on autonomous driving yet. They're also expanding their battery storage business, and the Optimus robot continues to develop as a potential factory worker. Now, here's where things get really interesting, and by interesting, I mean quite alarming. Tesla is currently sitting at a share price of $355 with a market cap of approximately $1.4 trillion. But the number you really need to focus on is its price to earnings ratio. Tesla's PE ratio right now is about 351 times earnings. To put that in context, Tesla earned about $1 per share over the last 12 months. So you are paying 355 years worth of current earnings to own a single share. That's less of a valuation and more of a bet that the AI, robotics, and autonomous driving story plays out perfectly. And there are reasons to be cautious. EV sales in the US were down 28%. BYD has now overtaken Tesla in global sales. Tesla's economic profit has flipped from a gain of $760 million to a loss of $2.6 billion over the past year, and brand perception is slipping in key markets. Now, the 12-month analyst price target for Tesla is around $397, which is a small gain of about 9%, and the stock is rated to hold. So analysts aren't predicting a collapse, but they're also not rushing to buy at 355 times earnings. So the upside doesn't really compensate for the risk at this valuation, unless you truly believe the Cybercab and Optimus stories are going to transform Tesla's earnings beyond recognition. Tesla doesn't pay any dividends, so you are relying entirely on that share price growth. Next is Apple. Apple's main focus for 2026 is to move towards its highly profitable digital services, things like its App Store and iCloud. It's been a really big few months because the brand new MacBook Neo launched in March. Apple Intelligence continues its rollout, and Apple is looking to use that to trigger a multi-year iPhone upgrade cycle. The iPhone 18 is expected this year, and it's rumored the iPhone Fold is in the pipeline. And at a market cap of around $3.6 trillion and a share price of roughly $246, Apple remains one of the most extraordinary companies ever to exist. And compared with where it was a few months ago, Apple actually looks like a bit better valued. Its PE ratio is now around 30 times earnings, and analysts have a 12-month price target of around $300, which is roughly 18% up from today's price. The consensus rating from 77 analysts is buy. The question, as always, is whether you can expect transformational growth at the size it is now, And the honest answer is probably not. But steady, profitable, compounding growth? I mean, Apple has done that for decades. Now, if you're looking for financial data, you might notice something interesting. If you switch between Trading212, Google Finance, and other websites, you might notice that things like PE ratios and dividend yields actually don't match up. They're different. So you don't know which data to trust. For the last 3 years, I've been using Simply Wall Street for all my research because they receive their market data directly from S&P Global, part of the company that produces the S&P 500. And because of that, they provide some of the most accurate data you can find anywhere online. So when I'm doing my research, it really is the best source of information that I've found, and you can use their website or an easy app. But it's not just for researching stocks. It also links securely to my Trading212 portfolio in real time, giving me live analysis of my portfolio strengths, weaknesses, and my exact dividend income. For me, if I'm investing £15,000, I'd rather spend a bit more to make sure I know exactly whether that money is in the right place, because every 1% can be £150, so I use it all the time to make sure I'm investing in the right places. So you can use the link in our description to get a free account for life or get 30% off any of their paid plans to link your portfolio and a bunch more features. This is an affiliate link, so you'll get a discount and I'll get something too. But if you want to, click the link to check them out so you can do your research and get better insight into your Trading212 portfolio. Next is Amazon. While we know Amazon for buying stuff online, investors care about cloud computing and global AI infrastructure, and Amazon is firing on all cylinders. Amazon Web Services is the main driver with record revenue and sitting on a $200 billion order backlog from customers waiting for more data center capacity. Amazon's own custom AI chips are reducing reliance on Nvidia and improving margins. Their advertising business is surging at 22% growth year on year and operates at far higher margins than shipping boxes around the country. And Amazon Leo, the satellite broadband network, is now becoming competition with Starlink. Amazon has also recently acquired Fauna Robotics, making a move into the humanoid robotics space that puts them in direct competition with Tesla's Optimus. Amazon is currently priced around $200 with a market cap of about $2 trillion. Now, the stock is actually down around 9% so far in 2026, which has created a very interesting setup. Revenue for the last 12 months came up 12.4% year on year, and the PE ratio is around 28 times earnings, which is actually below Amazon's 5-year historical average. So the analyst picture here is very compelling. Out of 45 analysts, the consensus is strong buy, and the average 12-month price target is around $279, which implies a roughly 40% upside from today. The main risk to watch is CapEx. Amazon is spending $131 billion on capital expenditure in the last 12 months, which has reduced free cash flow. But the growth story across AWS advertising and logistics automation suggests that spending is going to work over time. Stock 4 is Microsoft, and the story here has changed. Microsoft's primary focus is business software and cloud expansion, as well as monetizing their AI. They are adding over 1,000 new features to Microsoft 365 this year, heavily centered on Copilot AI integration. Because their software is so set in the corporate world, they have huge pricing power, so they can and do raise subscription prices globally, and their customers mostly have no choice but to pay. On top of that, 2026 marks the first year of extended security updates for Windows 10, forcing businesses to pay escalating fees or to upgrade, so higher revenue. Microsoft's share price is currently around $370 and it's fallen around 30% from its last highs. And here's why that's interesting. Look at the PE ratio. Microsoft is currently trading at just 23 times earnings. That's 25% below its own 10-year historical average of around 31 times earnings. In fact, it's trading at the lowest valuation multiple we've seen on this stock in years. And the business itself has not deteriorated. Revenue was $305 billion over the last 12 months, profit margin sits at 39%, free cash flow is $77 billion. This is one of the most profitable businesses in the world, and it's on sale relative to where it normally trades. Now look at the analyst consensus. The current average 12-month price target from analysts is about $597, so a potential growth of around 66%. The consensus rating is strong buy with 0 sell recommendations, and on top of all of that, Microsoft pays a dividend of around 1%, the best income in this top 5. If there is one stock on this list that appears to offer a combination of value, stability, growth, and income, Microsoft right now looks like a compelling case. And finally, Nvidia. Nvidia is no longer just a graphics card company, they are transitioning into a full AI infrastructure platform. They unveiled their new Vera Rubin architecture, delivering 10 times higher output than previous models. They are expanding into sovereign AI, where governments are spending billions to build localized data centers, and even launching the Space One, which aims to bring AI data center capability to satellites. And they've just announced a joint AI lab partnership with Eli Lilly, bringing up to $1 billion invested over 5 years, bringing AI into the drug discovery industry. Now, Nvidia's share price is currently sitting at around $174 with a market cap of about $4 trillion, making it the most valuable company in the world. But here's the thing. Earlier this year, Nvidia was trading above $200. The stock has pulled back and now the valuation is more reasonable. The PE ratio is around 35 times earnings, but even more striking is the forward PE, which sits at around 21 times earnings. That is actually cheaper than most S&P 500 stocks. In 2026, Nvidia's revenue came up 65%. Earnings were also up 65%. These are great numbers for a company of its size. Analysts are strongly bullish, the consensus is strong buy, and the average 12-month price target from 38 analysts is around $266, or roughly 52% upside from today. The main risk is that competition is growing. AMD, Intel, and Alphabet's own chips are all pushing harder, and even a hint of demand slowdown could mean a significant move downward. But on current fundamentals, Nvidia's pullback has made it look more interesting, not less. So if you're an investor on Trading 212, which one actually looks like the best on paper right now? Well, by PE ratio, Tesla is in a league of its own at 306 times earnings. That's not a valuation, that's a prayer. Nvidia trades at 34x, Apple at 32, Amazon at 28, and Microsoft at just 22x, which is the cheapest of the 5 and 28% below Microsoft's own long-term historical average. On pure valuation grounds, Microsoft is the standout. On highest analyst upside over 12 months, Microsoft again leads the group with a massive 66 potential upside to its average analyst target. Nvidia follows at 52%, Amazon at 40%, Apple at 18%, and Tesla at just 9%. So, to break all of this down, when we look at all of the real-world financial data, it looks like Microsoft is coming out on top as the best value buy right now, with Amazon coming in at a decent second place. Nvidia is interesting after its price pullback, Apple is solid but won't set the world on fire, and Tesla is a faith-based investment at this point. But guys, that is it for today's video. If you enjoyed it, please be sure to click on the like below and subscribe for more videos like this one. Remember to check out Simply Wall Street for your research in the description, and I'll see you next time, as always, on Casual